You are listening to Keystone's Stock Talk Show, episode 273.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment, and we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. I will start with following up on my segment from last week, which took a look at our recent live webinars, which used past successes to identify three commonalities in 10x stocks. This week, I will touch on whether or not the data backs up the commonalities seen in our past 10x stocks. In our Your Stock Our Take segment, Aaron reviews a company which we have sat down with over the course of this year, Kits Eyecare, symbol KITS on the TSX, a vertically integrated eye care provider, which has seen its stock rise 64% in 2024. Aaron lets the viewer know whether this jump is justified based on the underlying numbers. Brennan answers a viewer question on a few high-flying oil and gas tanker companies, including HAFN Limited, symbol HAFN on the New York Stock Exchange, Cool Company Limited, CLCO on the New York Stock Exchange, and TORM PLC, TRMD on the NASDAQ. Finally, Brett takes a viewer question on ADF Group Inc., symbol DRX on the TSX, and North American leader in the fabrication of steel structures. The stock remains up 50% on the year despite being cut in half from its year highs. A viewer noted that he is thinking of taking a position in the stock and wanted Brett to take a look at the stock and see if the roller coaster ride will continue through 2024. All right, let's get to the show. My co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing?
Doing well.
Doing good.
Great.
I got a unique show this week. I will be hosting the start, but about a third through the show, I will literally have to duck out to catch a flight to Florida, hopefully avoiding another potential hurricane, surviving Disney World, then ending with a couple presentations with Aaron at the Orlando Money Show. It promises to be an adventure over the next several weeks, but we'll get through it, we hope.
A Disney adventure.
A Disney adventure. Yeah, the happiest place on earth and the most flooded place if some reports look like it could get there.
Yeah.
We'll see. The poll question, Brett, we might as well get right to that. Which of the following commodities are you most bullish about? I think that's it. Right?
Yeah, so this was actually a repeat of a question we had previously in the year, just to see if there was any really significant shift in people's outlook. So the most recent poll, the one out over the last week, which of the following commodities were you most bullish about? Oil and gas came at 32%, gold came in at 25%, uranium came in at 25%, copper at 13%, and lithium down, rounding off at 5%. It's actually interesting. Lithium is the one which I'm not surprised about. It actually dropped off, which isn't surprising. I think we've really seen a slowdown in just really the EV buys. You saw the lithium market itself as well slow down over the past couple of years. And as well, oil, I think if we asked this last month, it would have been a bit less optimistic because we have seen oil come back up a bit over the last month with heightened tensions in the Middle East. But then it's been offset by this year with a slowdown in China, which is interesting. You have a couple things weighing off each other. Then you have like this overall pessimistic, then optimism switch back and forth into the US just to do with its overall economy, which obviously plays into oil demand. So yeah, I don't know any other interesting things you guys had anything.
I voted gold personally. Realistically,
why gold?
Who the heck knows? But the reason gold is because just the tensions in the Middle East. I thought that there'd be some positive sentiment there. As all of a sudden Iran and Israel are have basically crosshairs on each other now directly.
But why not oil then? If there's
Well, I could only vote on one of them, Aaron, so I had to
The real
I had
question
to
is,
pick
why do I
wisely.
need to be so obsessed with critiquing your opinion?
It's true.
It's fair.
Yeah.
It
No, I was just
So
curious. Yeah, you've got to. I mean, obviously, for those who are bulls on gold, gold is always seen as kind of like a hedge to, well, one, inflation, but also just global economic uncertainty, right? So anything that happens to reduce confidence in the global economic system is supposed to be a net positive for gold. Although we found that, it doesn't always work out like that, right? It's certainly not a clean relationship as what many think that it is. And in some cases, the relationship actually breaks down. It'd actually be interesting to do a segment on that and just really look at it statistically and see where, during certain periods where you would expect gold to perform well or perform poorly, to see how it's actually done, see what the numbers say.
totally.
Yeah, and
And
there's sorry, I'll let you go.
on your question about lithium in the prior poll was 10%, so it got a couple less votes effectively. And as well, copper rose, and oil, gold, and uranium were effectively the same.
Right. Yeah.
And this was from 7 months
lithium,
ago.
because 2023 was a very bad year for the rare earths. If you look 2021, 2022, the EV trade was just, it was all the hype, right? Like if you were in an industry that was seen as contrary to the EV trade, you were taking some serious flack and you were getting hurt in the market. But then 2023, we saw a huge decline in rare earth prices, and then also in the stock prices of many of the companies in the space.
Okay, well, now I'm going to move to my segment. I'm going to share my screen here first. Okay, last week we looked at some real examples of stocks that have gained greater than 10x from Keystone's buy recommendation universe. This week we're going to look at the data. There's a recent study, a great study that was put together by Jenga Partners over the past 10 years. This was from a period between 2012 and 2022, so quite recent. The commonalities that were found in this study from stocks that went up 10x globally, 87% of all global equities are stocks that went up 1,000% or 10x or more over the past 10 years, started as micro or small cap stocks. 82% of those were profitable at the start of their ascent, and 91% had some history of profitability. So here we see the key is small, profitable, and unknown. This is one of the specific reasons that we focus on profitable small caps. But if you want further research on the subject, Hendrik Bessembinder, the famous or infamous Henry, did a study. It was entitled, Do Stocks Outperform Treasury Bills? He studied 26,000 stocks from 1926 to 2015. His answer, by the way, was yes, they did outperform. But the key, however, in terms of our presentation here today, was the most significant variable was net income growth. Again, further evidence to support our strict adherence to looking at only and investing in only profitable stocks. More studies. There's well-documented academic research, Professors Eugene Fama and Ken French. The outperformance amounted to approximately 285 basis points from small caps annually since 1926, nearly 3% higher annually. That makes a massive return difference over the long term. If you like graphs, you can take a look at this one. It's between 1926 to 2004. Large cap stocks had an average annual return of about 9.26%. So $10,000 in those large caps from 1926 to 2004 would have grown to 10 million. Not too shabby. However, it pales in comparison to the kind of astonishing return of small caps over that period, 15.9% annual return. So $10,000, 1926 to 2004 would have grown to about $1 billion. I'm not a mathematician, but I'm going to take the billion over the 10 million. So again, now in the past 2 weeks, you've seen real world examples on the case for profitable small caps, undeniable data here on profitable small cap stocks and their potential to produce 10x returns or outperform in the long term. I'm going to leave you with one quote from perhaps the greatest investor of all time and a man who has openly pined for the days he could invest in quality small caps. He said, and I quote, "It's a huge structural advantage to not have a lot of money. I think you could make 50% a year. I could make you 50% a year on $1 million. No, I know I could. I guarantee that." In this context, it's unfortunate for his returns that Warren now has too much money. But unless you have several billion in loose change kicking around, you can take advantage of profitable small caps and try to find the next 10x stock. Trust me, your ability to invest in these stocks is the one and only advantage you likely have over Buffett. So we can help you use that.
Just the other day, I was saying to Ryan, like another quote from Peter Lynch, which again is just so similar. He says, "Look for small companies that are already profitable and have proven that their concept can be replicated." He also goes on, if you find a stock with little or no institutional ownership, you found a potential winner. Find a company that no analyst has ever visited or that no analyst would admit to knowing about, and you've got a double winner. Again, obviously, you need to find like good fundamentals in a company. It's not just, is there no institutional ownership? Oh, that's an automatic winner. No, obviously, that's not how it works. But again, I find that you can look at, a lot of Peter Lynch and a lot of Warren Buffett, and, they're really, pointing in the same direction with a lot of their comments and their investing styles.
Yeah, it's a good point.
Yeah.
All right.
I was going to mention, even when you're mentioning the small caps, the ones that are outperforming, you have to remember, and you looked at this a couple of weeks ago with the ETFs, is you can't just pick any small cap company when it comes to it. And I don't think that's dressing up in the Fama French model, which is what I forget the first names, but it's always called Fama French. They actually break, they break it down by 5 factors, and the small minus big factor is just one of the 5 versus, and you have to worry about obviously other things even within this model. So it's not just pick small cap, you're going to do great. You can't just buy an ETF. Like, you'll have many people just say buy ETFs. You get a lot of just poor companies, which really remove the benefit of the small cap when you're looking at just a broad range of small cap companies where it's just, they try to get revenue growth, they fall apart, they dilute, they raise money, and that just disappears any investment value, really.
Yeah, and that's why I say, and obviously I'm biased here, but we can help you in that area. We focus on very specific, profitable, small cap companies with growth, good balance sheets, and a number of other factors. I mean, we went through in those webinars 10 factors, and that's 10 of 20 plus factors we may look at when we look at individual small cap companies. All right, I think that's going to end off this segment. Before I jump onto that flight, Aaron's going to look at KITS Eyewear, or Eyecare. KITS, KITS on the TSX.
Okay, great. Thank you. Happy to do your stock, our take on KITS Eyecare. The symbol is KITS on the Toronto Stock Exchange. And what KITS is, it's a vertically integrated direct-to-consumer eyewear company. So they retail eyeglasses and contact lenses through their e-commerce platform. They do have one brick and mortar store, but they're primarily an e-commerce business. And the way that they see themselves as fitting into the market is that they're essentially, by vertically integrating, they're able to take a lot of the costs out of the process and a lot of the time out of the process of manufacturing, assembling, and then delivering glasses to people. So they're able to offer glasses essentially with a shorter turnover time and also at a lower price relative to most comparables. So the company is trading right now at just over $10 per share. It's about a 320 million market cap company with 32 million shares outstanding. So this company has performed incredibly well, certainly this year. The company originally went public in an IPO in 2021. And then after that, growth was fairly meager, but it's really in 2023 that the company started to take off. And so far this year in 2024, it's been an incredible year for the company. They're up about 65% year to date. And we've seen good, solid revenue growth and market share gains as well. So full disclosure, before we go any further, I am actually wearing a pair of KITS eyeglasses. And Ryan and I did have a meeting with the company. We've actually had a couple meetings with the company, but we had one where we went down to their offices downtown. Then we went out to their manufacturing facility in East Vancouver. We did a full tour. We took a look at the operations. And then afterwards, a little while afterwards, I decided to test out the whole process by ordering a pair of glasses. These weren't glasses given to me by the company. I actually went through the full process of ordering them online, providing my prescription, paying for them so that I could see this from the perspective of the customer. So I do have some insight into the company as a customer. But going through the whole process, so essentially they have a manufacturing or assembly facility in East Vancouver that we toured. And what they do is they design their own frames. They have a designer, a full-time designer, that creates these designs based on what they deem to be trending styles. They have the frames manufactured, I believe, in China, sent to the company. So they have a big inventory of different types of frames. As well, the lenses as well, the raw lenses are also sent to them to their facility from an outside supplier. But what happens is when they get an order, they get the lenses and the frames from their inventory. They use these big machines here to essentially cut the lenses so that they will fit into the frames. Then they have other processes afterwards for assembling them, quality assurance. But these are big, expensive machines. I think they were like a couple $1 million each. They had 3 of them, I believe, maybe 4, if memory serves. So yeah, it was very interesting. And what I will say, certainly as a customer, is I thought that the experience was positive. These are good glasses. I would go as far as to say these are, possibly the highest quality glasses I've owned. Now, in terms of price, I paid about $300 for them. I know that with a lot of the marketing that I saw, I was kind of under the impression that they were talking about selling glasses for $50. I believe that is just referring to the frames. So then there's always add-ons, lenses and whatnot. Now, I did for $300 take every additional option. So this has the auto tinting. It has the higher quality lenses, essentially everything. So I did pay the highest amount that one would typically be expected to pay, but $300 is certainly more than I was expecting. I will say though that it's still lower than I believe I would have paid through my optometrist that I was using before and the glasses stores that I went to before. And then I got the glasses in about a week. So I think that they were true on their promise of a quick delivery time. So I got a high quality pair of glasses in a week. There was a little bit of a delay due to quality assurance, but I still felt that I got them in a fairly reasonable time frame. So as a customer, I feel pretty happy. Now, in terms of as a stock, we want to look at this a little bit differently. And of course, we look at the business from a product and market perspective, but we also look at the business from a financial perspective. So let's take a look at the recent financial results that were recent full financial results, which was Q2 2024. And they reported sales of about 38 million, up 26%, adjusted EBITDA of 1.1 million compared to a loss of $500,000 in the previous year. Higher adjusted EBITDA margins, 3.5% compared to 1.7%. And then net income, just really marginal net income, just above break even, about 200,000 for the quarter compared to a loss of 1.2 million. So we're seeing positive adjusted EBITDA here, although margins are still fairly low. I mean, an adjusted EBITDA margin of 3.5%. We would want to see some further expansion in that margin, particularly given that we're expecting the company to, or we would like the company to drive more profitability to the bottom line. So certainly good, strong numbers on the revenue line. Nice to see positive adjusted EBITDA, but really marginal earnings right now, and fairly minimal adjusted EBITDA. The company did on October 3rd release its preliminary third quarter results as well. So it looks like revenue growth is continuing to be strong, actually accelerating, growing 34% to 41.7 million for the quarter. Adjusted EBITDA margin of 3%, so up year over year, but down quarter over quarter, and then still maintaining a strong cash position. So, the company's still coming in close to or around that break even in earnings, I believe it looks like from these numbers, but relatively low adjusted EBITDA margin still. So this is something that we want to see worked on, and the company is working on it. We've seen from some of the information that they put out, Operating expenses as a percentage of revenue are declining. Revenue is increased. So it is moving in the right direction. But we still, at Keystone, we're very particular about our criteria of a company being a profitable business, meaningful and sustainable profitability. We haven't seen meaningful profitability yet from Kits. Now, looking at the company's historic financial performance going back to when they IPO'd in 2021, they've about doubled the revenue over that period of time. Not really a lot of growth in revenue until, it was around Q3 of 2022. That started to ramp up, and that has accelerated recently. And then also at the end of 2022 is where we started to see the company produce positive adjusted EBITDA. Now, this is a great sign on its path to profitability, but adjusted EBITDA itself is not profitability. It does not account for depreciation, taxes, interest, capital expenditures. So we want to see actual real cash-based profitability. But even looking at adjusted EBITDA, if we were to look at a valuation basis on the company, you'd be looking at valuation about 93 times EV to EBITDA. Now, to be fair, the company is not being valued by the market on EV to EBITDA. The market is not even looking at the EBITDA right now, except to the extent maybe that it's positive as opposed to negative. But it's not. There's not a lot of focus on EV to EBITDA at the current time for Kits Eyecare. But for us, in terms of profitability, I mean, having meaningful EBITDA and a reasonable price to earnings, price to cash flow, EV to EBITDA multiple, something that's within a range that we would consider reasonable. That would be a requirement for us to invest in the company. Now, looking at it as a price on sales, it's about 2.2 times. That's reasonable. I don't think that that's unreasonable, really. But where we're really seeing the company fall short based on our criteria is on that profitability and on that EBITDA. So we can't really measure a price to earnings on this company right now because it isn't producing much in terms of earnings. So our take on Kits Eyecare, I do think that it is an excellent product. I'm very happy as a customer. I'm going to give them more of my money, certainly in the future. They also have potentially a very strong runway of growth. The company has been accelerating its revenue growth in recent quarters. And then they also state that they have up to 500 million in revenue in production capacity right now. So a lot of room to grow with their current facilities. So that strong momentum with the revenue, and then positive EBITDA is certainly a positive thing that the company has produced over the last 2 years. Now, adjusted EBITDA margins, on the other hand, are still quite low. So it's fairly marginal EBITDA, certainly very marginal profitability. They're just kind of starting to break into profitability. If they can expand those margins as they're growing the revenue, there's a lot of potential to drop more profit to the bottom line. But they need to demonstrate that they can do that. And that hasn't been demonstrated quite yet. So our take, it's a very interesting company. We liked the meeting. We will continue to monitor it closely, but it's not fitting our Keystone profitability criteria at this time. And until that happens, we couldn't make a recommendation on the company.
Yeah, exactly. I think you hit the nail on the head. And even when they do, start, say they all of a sudden start, generating maybe EBITDA margins of 6 to, 8 to maybe 10%. Well, what kind of EV to EBITDA multiple would they demand, in the market? Obviously, we have to analyze growth and, as long as they can continue to grow. But typically, a company with, a 10% or a 6% adjusted EBITDA margin will, demand a lower EV to EBITDA multiple. Again, it all depends on the growth rate and whatnot. But, I think that that is something to keep an eye on when all of a sudden they do start generating more meaningful EBITDA. If they do.
Yeah, and I'd probably have to have another discussion with management just to kind of figure out what is a realistic upper bound for an EBITDA margin for that type of business? Because in a lot of businesses, you're kind of restricted just given the cost structure, the nature of the business, right? So I don't know, but certainly single digit EBITDA margins or operating margins are what we would consider to be a low margin business. Now, I'm sure that the company can improve from here. We don't know at this time what the time frame is or when that's going to happen. I will say that the company certainly seems to be getting a lot of attention in the market without the onus of actually having to produce profitability. So they may actually be of the perspective that like, well, why would we want to drive more profit to the bottom line when we can just invest more into marketing and operations and growth, right? Which is fine as long as you eventually, are able to drive that profit to the bottom line. What we have seen in the past is that often that just never ends up happening, right? That's always the intention long term, but it just never ends up happening. Sometimes it does. We hope it does with Kets.
Yeah, I know if Ryan was in here, he'd say like, a lot of companies that are just trying to capture that growth will all of a sudden make like a culture within the business of, never focusing on the bottom line, which is something that we want to avoid.
Because it's not always an easy thing to do, particularly if you're a lower margin business. That means that then you have to really, focus on being a bit of an accountant and a penny pincher, right? And it's not a fun job, right? So, if it's a high margin business, you don't have to do that. But if it's a low margin business, you need to really focus on that.
It's fun for an investor when you see those cost savings programs, though, for sure, and then they start getting implemented. Sorry, Brett, go on though. I cut you off.
So just on the margin, like you can generally use like gross profit is like obviously it's still ways off of net income, but you can use a gross profit margin in Kit's cases hovers in the low 30% range, so 30 to 33% over the last 10 quarters. Mm-hmm. So then you can say, okay, I go from there, I look at the SG&A, and that's their major next grouped expense. How much do they have to bring that down? Because you can improve gross margin to a degree. You get efficiencies. You do get some economies of scale, but not normally to a great degree in a manufacturing business. It depends on the type of business. Sometimes they will have some sort of fixed cost in cost of revenue or cost of goods sold. But most time in manufacturing, you can't move that dial too much. So you really have an upper bound of 30%. Right now, their SG&A really takes that 30%. If they triple their business size, which would put them at that 500 million in revenue or so, it would be a bit less than that, but we'll just use triple. That would take the SG&A to 10% of revenue from 30. You'd have a 20% operating margin. That's likely unrealistic, but there's your high in the sky, 20% margin, upper bound kind of limit. And that's what you can really use to ballpark these figures. And that's really would be like the most optimistic. They don't have to increase SG&A, which they have as their revenue has increased, and you would expect that in a business. But there's your high in the sky estimate, 20%. But then realistically, you take that down from there, it's likely going to be, like Aaron said, low net income margin, low adjusted EBITDA, whatever margin you want to use. Maybe you could squeeze out a low 10, 11% double digit in the best case scenario, but that would be the optimistic scenario, which I would consider realistic.
And we don't know, like, if they ramp up revenue to 500 million. I mean, if they were to keep their fixed costs, if they were to keep their gross margins stable and their fixed costs stable, then yeah, you're going to have huge net income growth and margins there. But fixed costs aren't necessarily fixed. They just don't change directly with the number of units that you sell, right? So fixed costs are still likely in some areas going to increase. As they do that, you still have to have more customer service. More other costs as well will be added on there, probably more shifts of labor. So it's, it's very interesting. I'd like to see more net income.
Yeah. Okay. And without Ryan here, I will segue us into my segment. So I will share my screen here. And yeah, I apologize. I'm a little under the weather here, so hopefully I'm not coughing or sneezing while I go through this. But yeah, I thought that I would cover or look at these three tanker companies as we were asked a question by a client in our Canadian income stock chat last week. And the question was on HAFN Limited, Cool Company, and TORM PLC. So first up, HAFN Limited, or HAFN, on the New York Stock Exchange, currently trading at a price of about $7.31, a $3.8 billion market cap. And they own and operate oil product tankers in Bermuda. The company transports clean and dirty refined oil products, vegetable oil, and easy chemical to national and international customers. And the company owns and operates about 200 vessels. Next is Cool Company, or CLCO, on the New York Stock Exchange, currently trading at about $11.41 with a $625 million market cap. And they engage in the transportation of liquefied natural gas. The company owns a fleet of about 11 LNG carriers and manages 17 floating storage units for third parties. And last here, TORM PLC, or TORM, or TORM on the NASDAQ. trading at about $32.18 and a $3.1 billion market cap. And they own and operate a fleet of 90 product tankers in the UK, and it operates in two operating segments, tanker and marine exhaust. The tanker segment transports refined oil products, while marine exhaust develops green marine equipment. Now, on this slide, we can see Cool Company in blue, which is down about 10% since March of 2023. The red line is TORM PLC, which is down about 4% since March of 2023. And the purple line is HAFN, which is up about 1% since it went public on US exchanges in April of 2024. So really, it has been a bit of a flat year for all of these tankers. Now, of course, the single most important indicator that affects tanker companies' performance is shipping rates. And we can analyze this by looking at the Baltic Exchange Dirty Tanker Index. We could also look at the Clean Tanker Index as well. But this indicates the cost of shipping unrefined petroleum oil on a basis of the average costs of 17 routes. And the average rate of each route is calculated by the Baltic Exchange in cooperation with a panel of major ship broking companies. And you can see here from this index that in 2022, when oil prices were increasing in unison with supply chain constraints and rebounding demand during the pandemic, it elevated shipping prices quite drastically, which was good for tanker companies. But following the outbreak of the Israel-Hamas conflict, which led to Houthi rebels to attack ships in the Red Sea, leading to the Red Sea crisis, risk premiums for vessels traveling through the area increased or, kept the shipping rates higher as well, although not as high as during 2022. So let's look at the financials of these businesses over the past several years. And specifically in terms of HAFN and TORM, which have reported much longer as public entities, we can see that these rate increases in 2022 to 2023 have elevated revenue and their profitability. Where, looking at HAFN, they did about, $811 million in 2021. Well, 2022, it jumped to about $1.9 billion. The same could be said about TORM essentially as well. And of course, their profitability was also propelled as well. Now, just quickly looking at the fundamentals of each business, note that all of these companies do have a variable dividend policy, and each have quite attractive yields. And I can understand why, our client was asking this question in our Canadian income stock chat. But again, their yields are variable, so keep this in mind. And for example, the payout ratio for HAFN depends on its net loan to value ratio. And all of their payout ratios in the most recent quarter are quite similar. So they look decent, in my opinion. Now, each trade with a relatively low price to earnings multiple, which is expected given these type of tanker businesses do not demand much of a multiple altogether. And they're pretty close to in line in line with their 5-year median price to earnings multiple. And just quickly looking at their balance sheets, HAFN and TORM carry a much better balance sheet compared to Cool Company, with each having a net debt to EBITDA multiple of around 1 times, where Cool Companies is about 3.7 times. So to conclude, tankers can be quite cyclical, and the uncertainty of macroeconomic factors and how they impact the businesses generally keep us on the sidelines. Elevated shipping rates for tankers have led to a strong 2022 to 2024 period. And this, of course, like I said, was from pandemic supply chain constraints and pent-up demand in 2022. And then as well, coming into this year, the Red Sea crisis, as well as the Panama Canal drought. And directly from HAFN's conference call, they indicate HAFN operates in the very cyclical tanker segment, and growth is partly due to the Red Sea crisis, increasing shipping costs, droughts in the Panama Canal, and low diesel inventories in Europe, contributing to a strong second quarter with increased volumes on the water. So the million-dollar question is, will the strong operating environment and shipping rates continue for these tankers? Well, in my opinion, I do not see them easing immediately. We're still seeing tensions in the Middle East. But if we do see tensions ease in the Red Sea and macro tailwinds ease, their financials can easily fall as fast as they rose, likely leading their share prices lower. But overall, their yields are attractive. Just keep in mind that they will fluctuate based on their earnings as they are variable. So yeah, that's my segment.
So can you remind me with Cool Company, sorry, do they do refrigerated shipping?
Correct. Yeah, correct.
Right. Okay. So they specialize in refrigerated shipping and the others are like dry bulk.
This is correct. Yes.
Or cargo shipping. Okay. So
Yeah.
it's interesting because, it would be interesting to know, I mean, the numbers in terms of a balance sheet look very different.
Mm-hmm.
It'd be interesting to know if there's like some type of a different dynamic in terms of the volatility of shipping prices for specialized cargo, like refrigerated cargo.
No, that is a great, point. Cause like even before, like I was looking at like, actual just like shipping containers. But again, we're dealing with like different animals here when we're dealing with, these like shipping crude and like you said, liquefied natural gas, which has to be cooled. So it's not perfect. Even when I was like looking at my like the Baltic Exchange Dirty Tanker Index, technically like there's other indexes that we could be looking at depending on like even for like LNG. So that is something to keep in mind. But again, I think that generally shipping rates have kind of went across the board up just because of what we're seeing in the world, I guess, right now.
Yeah.
And I would say because there is, when you are seeing the reason why they are getting a higher return is because they are accepting higher risk at that point, whether it's they may be paying higher insurance, but they also risk whether it's a drought in the Panama, if they have to take a very long route around the continent, or if they just have to wait and they can be waiting there for weeks or at a time if there's a significant delay. And you saw that with the Evergreen delay in the Suez Canal a few years ago when all the ships just effectively had to wait 2 years or go around the Horn of Africa or back around the Cape. But yeah,
exactly.
You need to accept that risk, and that's the risk of the business. And that's why you get these 15-20% dividend yields, because they pay out all their cash, and that's what you're getting in return for accepting that high risk.
Like even like I was reading, I believe it was a Forbes article, but they were looking at just like, the 2022 kind of supply chain crisis where typically it was about a half a day a tanker or a cargo ship would be at a port. Well, that like raised to like, I'm pretty sure on average 16 days that cargo ship would end up being in the port. So it was just, it was a crazy time. And again, if we see all of a sudden that normalize, well, I would assume that, these share prices come down with their financials. But again, it's, there's lots of macro variables at play here, which, is just who knows what will happen.
All right. So we can move on to my segment. And I am doing ADF Group. So ADF Group, symbol DRX on the TSX, provides designs, engineering, and fabrication services for large complex steel structures. So bridges, skyscrapers, non-residential, commercial, industrial sites, and the like. The company has capacity to produce 125,000 tons of steel annually for an array of buildings. The company has manufacturing facilities in the US and Canada, but most of their revenue comes from the US. The stock is currently up 48% year to date, trading at 10.30 and a market cap of 308 million, including the unlisted multiple voting shares, which they can be converted to normal shares. And you will see Google is one of them, which is why I'm mentioning is online sources, they don't include those unlisted shares by default. So if you do see a significantly lower market cap, something like 180 million, that's why the market cap is significantly higher than what it seems. The stock has, however, come down significantly since it's at an all-time high of over $20 a share earlier this year, so falling by roughly 50%. Even though it is up 50% effectively year to date as well, it really did run up the first half of the year, but has since come down. So first, looking at a high-level view, we can see significant revenue and net income growth over the last year and a half or so, correlating with that just massive increase in the stock price as well. At the same time, revenue grew and gross margin grew, ultimately allowing really for that net income margin to grow at a significant rate. With a contract-based business like ADF Group, you will have significant quarter fluctuations, but the overall trend has been significantly positive. And you can see there, gross margin increases, it effectively directly contributes to net margin. Then that really shows economies of scale for a business like this. So why is the stock surged and then now has settled down? Looking at the most recent financials, fiscal Q2 2025, the company had revenue of 75 million compared to 80 million the prior year, attributing the decrease to delays on one client's construction site. The delay had roughly a 35 million impact on the quarter, while the revenue is not completely lost, just delayed. Due to the shift in installation schedule, the revenue is likely to be pushed until next year, as the major material input of steel does impact revenue. It is, however, largely passed through to customers, so it doesn't really impact gross profit. So just keep that in mind. You can see revenue increase just due to steel prices because they pass that through, but then gross profit as an absolute value doesn't necessarily increase when that does occur. But gross profit did grow by 55% to 27.6 million from 17.8 million at a gross margin of 36.9%. The increased gross margin primarily relates to better fabrication volumes, allowing for better absorption of fixed costs, and as well as they had a favorable product mix during the quarter. Net income increased to 16 million from 10.5 million, or 51 cents per share from 32 cents on a per share basis, driven by higher gross profit margins and supported by lower SG&A and offset by a higher tax percentage as their loss carryforwards, which they had been previously using to reduce their accounting tax expense, has been fully used. Now they're taxed fully, which is what you expect and what you hope. Eventually, even though it's a great thing to get those loss benefits, you ultimately want the company to be profitable, which means they're going to get taxed, whether you like it or not. Shifting to the balance sheet, it is strong. It has a net cash position of 29 million. The company did also repurchase during the year 2.8 million shares for 47.9 million, which is just under 10% of the shares, or 49.3 million when you include their fees for repurchasing. And they did that at an average price of 70.31. Although in hindsight, it probably wasn't the best time to repurchase shares, as it's dropped about $7 or 40% since that. It will help drive per share metrics going forward, as they obviously have a lower share count. The company does have a significant backlog still of 402.3 million, up from the prior year's 373.7 million, but that is down since the start of the fiscal year's 510.9 million. The company does expect the existing backlog to be worked through over the next 18 months, but that is something which you generally can use as a forward-looking metric is backlogs. And so it is a bit concerning when you do see it start to fall off, taper off. But a lot of times you will see a Q4 bump, and you can see that in the prior years, and then it does rebuild itself back up the next following fiscal year. So we can see if that happens or if it just continues to decline. And that is obviously something you want to keep your eye on. So the company does have just significant risk due to the operating business it's in. It operates as a construction industry, so it's very cyclical. So even if ADF is financially sound, its client and potential clients likely will still need to raise money. So in a weakened macroeconomic environment, funding can be harder and harder to come by, and willingness just by these companies to conduct major projects, major capex expenditures, just can decrease even if they do have the funding, ultimately lowering demand. So you just need to really accept that risk if you want to invest in a company like ADF, anything really in the construction industry as a whole. But that being said, ADF does state that they do look to have clients that are lower risk, they're financially stable, major companies compared to if you were looking at a company that is borrowing a significant amount of debt, they're small, they don't have significant outflows and so on. That's more risky than a large company with existing cash flows that is willing to fund it. But of course, general slowdowns can still just occur. So switching to valuations, the stock is trading at a trailing P of 6.3 times, and then adjusted EV/EBITDA of 3.4 times, and a price to FFO of 3.5 times. While these are somewhat lower than what the company has traded at since it's been profitable over the last few years, the outlook isn't really as strong with that lower backlog since the start of the year, as well as they have had that delayed project. They did announce that there was a significant 55 million order from Quebec, which may bolster the backlog. So not all doom and gloom. I don't mean that by any sense, but it doesn't mean that there's still some explosive growth like what the stock was implying with its price when it was in the $20 earlier this year. That was a very high valuation metric for a cyclical company. But now that it's come down, it is more reasonable. But it is not an extreme undervaluation either. While the company is better insulated given the backlog strength and market diversity, whether it be commercial, residential, or industrial end markets, compared to other construction companies, it is still ultimately a construction company. It's going to be cyclical, which means trading at what may be appearing cheap when you are at these cyclical peaks. So when you are at a cyclical peak, you'll see obviously the bottom line, whatever net income, FFO, EBITDA, whatever metric you want to use, those values will be inflated. But if you're looking ahead 2-3 years as these better contracts wind down, there isn't as the same robust demand. Those metrics start to fall. So even at the same price point, you start to see your metric expand, resulting in a higher valuation, even though the price hasn't changed the same. That's what you see in cyclical companies. So if you are really looking to invest in ADF, you are taking on a cyclical risk, specifically with the U.S. economy, as they primarily receive their revenues from U.S. based companies. It's something around 90%, even though it is a Canadian company. So overall, I really see risk outweighing reward at this time, as the stock price has, even though it has come off, it has appreciated tremendously, limiting that degree of potential upside while you're still retaining that external macro risk. So at this time, I'd really just monitor the stock, see if you can really get a better risk to return reward.
I've taken a lot of questions over the last couple of years about ADF, and the company's been around for a while. It's as you said, the fundamentals are generally quite strong, but it's just the nature of that construction work. It can be quite cyclical, right? I mean, it's very contract based. And so ADF is engineering consulting, right? Which is typically more of a fee for service, which is better than going contract based, but you're still going to only need the services when there's contracts, right? So it's good company, but you'd really have to invest in it over the cycle, as opposed to just looking at this and being like, oh, it's at 3.5 times EBITDA. This is something that should do well over the next 6 months to a year.
Yeah. And I mean, we have like one company which we recommended in the US, has done tremendously well. Again, just construction companies have been generally strong, I would say. We've seen many, performing quite well. And that, company which we recommended, I believe it's up, over 100% now. We did end up moving it to a hold, just kind of going along the lines of what Brett was saying. Again, we still like the company, but the risk is heightened. Like Aaron said, you want to be kind of investing through the cycle rather than just all of a sudden, seeing the financials strong and getting in then.
And that's what I would really want to get to the point is the numbers are going to look awful, and sometimes when the numbers look absolutely awful, that's the best time to invest in a cyclical company. And that's the difficult part to say is this cyclical downturn going to be 3 years, or is it going to be 6 months? Is it a COVID spike where everything recovers in a few months, or is it a prolonged recession? And that it's really, you need to, more so than other companies, take into the macroeconomic environment, which is the difficulty of investing, especially in the short term, even though a lot of times I want to call investing in a company that is so cyclical.
Great. Okay. That does it for this week's podcast. Thank you all for watching, and make sure if you found this content valuable, if you liked it, smash that like button, subscribe to the channel, also rate and review us on whatever platform you're using. We will talk to you next week. Profitable investing.
Thanks, everyone.
Thank you.